Breaking. Gold explodes past $5,000. Russia abandons dollar forever. Gold just crossed $5,000 and closed the week above that level for the first time in human history. Russia's central bank confirmed they're never going back to the dollar. Never. Bloomberg tried to tell you otherwise. The story was fabricated. Meanwhile, China just banned the one practice. That's been suppressing gold prices for decades. 3 events, 1 week. And most people have no idea what just happened. The question isn't whether the system is changing. The question is whether you'll understand it before it's too late. Welcome to Financial Crisis Explained. If you've been following global markets for more than a few decades, you know that moments like these don't come often. And when they do, they don't repeat themselves. We'd be honored if you'd subscribe to this channel, the way you might bookmark a trusted source during uncertain times. And please, let us know in the comments where you're watching from today, because what's happening right now affects every corner of the world. Now let's break down exactly what occurred this week, and why it matters more than anything you'll hear on mainstream financial television. The financial markets witnessed something on Friday that has never occurred in the entire history of recorded gold trading. Gold did not simply touch $5,000 and retreat. It closed the weekly candle above that threshold. This distinction matters more than most analysts are willing to acknowledge. Intraday spikes are noise. Weekly closes are signals. And this signal just told us that the global monetary system has entered territory without precedent, without historical comparison, and without any clear roadmap for what comes next. The spot price settled at $5,040 per ounce in Western markets. But that number only tells half the story. In Shanghai, the same gold was trading at $5,049, a $9 premium. This premium has been holding steady for weeks now, and it represents something far more significant than a simple arbitrage opportunity. It represents where the physical metal is actually flowing. Western markets deal primarily in paper contracts, derivatives, futures that rarely see actual gold change hands. Shanghai deals in physical delivery. When physical gold commands a persistent premium over paper gold, it means trust in the paper system is eroding. The COMEX futures market in New York shows open interest, equivalent to hundreds of millions of ounces. The registered inventory available for delivery sits at a fraction of that amount. This is not new information. But it has never mattered more than it does right now, because for the first time in decades, major global players are demanding physical settlement instead of cash equivalents. The previous psychological barriers in gold, $1,000, $2,000, were crossed during times of financial stress. Each time, mainstream analysts dismissed the moves as temporary panic. Each time, they were wrong. But those moves happened during periods when the dollar system itself remained fundamentally intact. What makes 5,000 different is not the number, it is the context. This threshold was crossed during the same week that Russia's central bank governor explicitly confirmed they are not returning to dollar-based settlements, not reducing dollar exposure gradually, not diversifying away from the dollar over time, abandoning it completely. The timing is not coincidental. When a major commodity exporting nation with significant gold reserves makes an irreversible monetary decision, and gold simultaneously breaks into unprecedented price territory, these are not separate events. They are two expressions of the same underlying reality. The global reserve currency architecture that has governed international trade since 1944 is fragmenting. Not slowly, not theoretically, but measurably and irreversibly. Central banks worldwide accumulated more gold in the past 24 months than in any equivalent period since the United States closed the gold window in 1971. This is documented, reported, publicly available data from the World Gold Council. The nations buying are not traditional Western allies. They are BRICS members, Middle Eastern energy exporters, and nations that have faced or fear future sanctions. The pattern is unmistakable. Countries that possess large dollar reserves are systematically reducing those positions and converting them into monetary metals. Russia's move is simply the most explicit acknowledgement of what has been happening quietly for years. And now, with gold closing above 5,000, the market is pricing in the permanence of this shift. Technical analysts will point to resistance levels and chart patterns. They are missing the point entirely. This is not a technical breakout driven by momentum traders. This is a repricing event driven by fundamental loss of confidence in fiat currency stability. The difference between Western spot prices and Shanghai premiums tells us exactly where that loss of confidence is most acute. Asian buyers are willing to pay more for immediate physical possession because they understand something that Western portfolio managers have not yet grasped. Paper claims on gold are not the same as gold. And when the system faces real stress, that distinction becomes existential. The weekly close above 5,000 is not a prediction of future price movements. It is confirmation that the future most analysts were modeling no longer exists. The assumptions that governed portfolio construction for the past 50 years, assumptions about dollar stability, about the permanence of Western financial dominance, about the interchangeability of paper and physical assets, those assumptions just failed their most important test. And most investors, most business leaders, most policymakers have not even noticed yet, but they will. Thursday morning, Bloomberg published a headline that sent shockwaves through precious metals markets. Russia considering return to U.S. dollar system. Within minutes, gold dropped $40. Silver fell $2 in coordinated selling. Algorithmic trading systems, responding to keyword triggers, dumped positions across multiple exchanges simultaneously. The velocity of the move suggested institutional panic. Except there was one problem. The story was completely false. Not misleading, not exaggerated, not taken out of context, fabricated. By Thursday afternoon, Russia's central bank governor Elvira Nabiullina issued a direct statement. No discussions about dollar reintegration had taken place. No consideration was being given to reversing their monetary strategy. No involvement whatsoever in any talks related to dollar-based settlement systems. Zero. The entire narrative had been constructed without a single verifiable source. And yet, it moved billions of dollars in market value before the truth emerged. This is not simply a story about journalistic failure. This is a story about how fragile market confidence has become, and how desperately certain institutions need the current system to remain intact. When a single false headline from a major financial publication can trigger that kind of volatility, it reveals something profound about the underlying stress in the system. Markets are operating on a knife's edge. Participants are hypersensitive to any indication that the de-dollarization trend might reverse, because if it does not reverse, if major commodity exporters permanently exit the dollar system, the consequences cascade through every layer of global finance. But here's what Bloomberg's false story actually confirmed. Russia is not going back. The very fact that such a story could be published suggests that powerful interests are deeply concerned about the irreversibility of Russia's decision. You do not fabricate hopeful narratives about outcomes you believe are likely. You fabricate them about outcomes you desperately need, but cannot actually produce. Russia's monetary pivot did not begin in 2022 with Western sanctions. It began in 2014, after Crimea. After the first round of financial restrictions, Russia's central bank began systematically redesigning their entire monetary infrastructure. They developed the SPFS, the System for Transfer of Financial Messages, as a direct alternative to SWIFT. They negotiated bilateral currency swap agreements with China, India, Iran, and Turkey. They restructured energy contracts to accept payment in rubles, yuan, and in some cases, gold. This was not reactive scrambling. This was methodical construction of parallel financial architecture. By the time comprehensive sanctions arrived in 2022, Russia had already spent 8 years preparing. The ruble-yuan settlement infrastructure was operational. Gold-backed trade mechanisms with BRICS partners were established. Alternative payment rails had been tested, refined, and scaled. The sanctions did not force Russia to abandon the dollar. The sanctions revealed that Russia had already abandoned it and built something else. Nabiullina's statement this week was not defensive posturing. It was confirmation of completed infrastructure. The Central Bank of Russia has increased gold reserves from approximately 1,000 metric tons in 2014 to over 2,300 metric tons today. That accumulation did not happen by accident. It happened because Russia understood something that Western policymakers refuse to acknowledge. Gold is the only asset that carries no counterparty risk. It cannot be sanctioned, frozen, or seized through financial system manipulation. Physical gold held in domestic vaults is beyond the reach of foreign monetary policy. And in a world where currency itself has become weaponized, that immunity is priceless. But Russia's strategy extends beyond simple reserve accumulation. They have begun backing certain trade transactions with gold convertibility guarantees, not returning to a classical gold standard, but creating hybrid settlement mechanisms where counterparties can demand physical metal instead of currency. This fundamentally changes the game. When an energy exporter offers settlement in currency backed by guaranteed gold conversion, they are offering something the dollar cannot match, because the dollar is backed by nothing except the creditworthiness of the United States government and confidence in the continuation of current geopolitical arrangements. Russia's strategy does not require the world to adopt a new reserve currency. It simply requires creating enough alternative settlement pathways that the dollar becomes optional rather than mandatory. And once the dollar becomes optional in energy markets, in commodity markets, in large-scale industrial trade, its reserve status becomes unsustainable. The Bloomberg fabrication revealed exactly how high the stakes have become. Mainstream financial media is now publishing outright false information in apparent attempts to stabilize market sentiment around dollar continuity. That is not journalism. That is propaganda in service of system preservation. And when institutions resort to propaganda, it means the truth has become threatening. Russia is not considering a return to the dollar. Russia has moved beyond the dollar entirely, and they are not coming back. While Western media focused on Russia's monetary defection, China made a move that received almost no mainstream coverage. And it may prove to be the most consequential regulatory decision in precious metals markets in 50 years. China's financial regulators issued a directive that went into effect with immediate implementation. No advance warning, no consultation period, no gradual phase-in. Effective immediately, all gold and silver rehypothecation practices are banned. Effective immediately, all off-exchange derivatives in precious metals are prohibited. 2 sentences, 2 regulations. And the entire paper gold pricing mechanism just faced an existential threat. For those unfamiliar with rehypothecation, the concept is deceptively simple. A bank holds 100 ounces of physical gold in custody for client A. That same gold is then pledged as collateral for a loan to client B. Client B uses that collateral to secure another transaction with client C. The same 100 ounces now appear on 3 separate balance sheets, supporting 3 separate financial positions. 1 piece of metal, multiple claims. This is not fraud under current Western financial regulations. This is standard practice, and it is how the bullion banking system has operated for decades. The problem emerges when someone actually wants physical delivery. If client A, client B, and client C all demand their gold simultaneously, only one of them receives metal. The other 2 receive excuses, delays, or cash settlement at current market price. But China just said, not in our jurisdiction. If you hold gold for a client in China, that gold cannot be pledged elsewhere. 1 ounce, 1 claim. Physical metal, physical ownership, no leverage, no multiplication, no fractional reserve gold banking. The implications cascade immediately. Banks operating in Chinese markets must now hold actual physical metal for every derivative contract they issue. They cannot sell the same gold multiple times through paper contracts. They cannot create synthetic exposure through off-exchange instruments that never touch physical settlement. Every contract must be backed by deliverable metal. This requirement does not simply reduce leverage. It eliminates the fundamental mechanism that has kept gold prices suppressed below physical demand levels. The COMEX futures market in New York operates on leverage ratios that would terrify traditional bankers. Open interest regularly exceeds registered physical inventory by factors of 100 to 1. Meaning, for every ounce of gold actually available for delivery, there are 100 ounces worth of paper claims. This works perfectly well, as long as most contract holders accept cash settlement. But if even 5% of holders demand physical delivery, the system faces immediate crisis. Shanghai Gold Exchange operates differently. Physical settlement is mandatory. Every contract must be backed by deliverable metal within the exchange's vault system. This is why Shanghai prices consistently trade at a premium to Western spot prices. Real metal costs more than paper promises. And now China has extended that physical settlement requirement across their entire financial system. The historical precedent for what happens next is uncomfortably clear. Between 1961 and 1968, a group of central banks known as the London Gold Pool attempted to suppress gold prices through coordinated futures selling. They sold massive quantities of paper gold contracts, driving prices down, while simultaneously delivering physical metal to anyone who demanded it. For 7 years, it worked, until it didn't. By 1968, the pool had delivered so much physical gold that their reserves were depleted. The mechanism collapsed, the gold window closed 3 years later, and the price of gold increased 20-fold over the following decade. China's regulatory decision creates the same dynamic, but in reverse. Instead of central banks selling paper to suppress prices while delivering physical metal, major banks will now be forced to acquire physical metal to back their paper positions. And there is not enough physical gold available at current prices to back existing paper claims. The Shanghai Gold Exchange reports daily physical withdrawal data. Over the past 12 months, withdrawals have exceeded new imports by substantial margins. Meaning, gold is flowing into Chinese private hands and disappearing from tradable inventory simultaneously. Chinese regulations now prevent that gold from being rehypothecated back into financial markets. It is being removed from the system permanently. Western bullion banks have operated for decades under the assumption that Chinese gold demand could be satisfied with paper contracts, ETF shares, and unallocated accounts. China just rejected that assumption entirely. If Western investors want exposure to gold price movements, they can buy paper, but if Chinese institutions want gold, they will hold physical metal with no encumbrances. This 2-tier structure cannot persist. Eventually, price discovery migrates to the market with actual physical settlement, and that market is no longer in London or New York. It is in Shanghai. The major bullion banks, the institutions that have managed gold prices through derivative positioning for the past 30 years. now face an impossible choice. They can continue operating in Chinese markets, which requires holding vastly more physical inventory than they currently possess. Or they can exit Chinese markets, which means abandoning the world's largest consumer of physical gold. Neither option is sustainable. The first requires capital they do not have. The second concedes defeat in the most important gold market on the planet. China did not announce this policy change with fanfare or explanation. They simply implemented it. And in doing so, they may have just broken the mechanism that has controlled gold prices since the 1970s. The question now is not whether prices rise. The question is what happens when the largest banks in the world cannot deliver the metal they have sold. 3 developments occurred within the same 7-day period. Gold closed above $5,000 on a weekly time frame for the first time in history. Russia's central bank explicitly confirmed permanent abandonment of dollar settlement systems. China banned the primary mechanism used to suppress precious metals prices through leverage. Financial media is treating these as separate stories. They are not separate stories. They are 3 symptoms of the same underlying condition. The global reserve currency system is not approaching a crisis. It is already in one, and the institutions dependent on that system are running out of tools to contain it. Coincidental timing in geopolitics is rare. Coordinated timing is common. When major powers implement structural monetary changes simultaneously without apparent consultation, it suggests they are responding to the same signals. Signals that indicate the current system has entered a terminal phase. The Bretton Woods framework, established in 1944, created a dollar-centric global trade architecture. Even after the gold convertibility ended in 1971, the structural dominance remained. Oil priced in dollars, commodities settled in dollars, central bank reserves held in dollars. This arrangement provided the United States with extraordinary monetary privilege, the ability to print the global reserve currency and exchange that currency for real goods and resources from other nations. But that privilege came with a hidden timer. As long as other nations were willing to accumulate dollar reserves, the system remained stable. The moment they stopped accumulating, or worse, began actively reducing holdings, the mathematics became unsustainable. That moment has arrived. Russia is not reducing dollar exposure gradually. They have eliminated it. China is not diversifying away from dollars over a 20-year horizon. They are systematically restructuring their entire financial system to operate independently of Western currency mechanisms. And they are doing it now, not in some distant future planning cycle. The strategic window for dollar-dependent economies is closing faster than policymakers are willing to acknowledge publicly. Treasury auctions are seeing reduced foreign participation. The percentage of U.S. government debt held by foreign central banks has declined from over 50% a decade ago to below 30% today. That trend is accelerating. When foreign buyers retreat from Treasury markets, the Federal Reserve faces an impossible choice. Allow interest rates to rise to levels that attract new buyers, which would collapse the domestic economy under debt service costs, or monetize the debt directly through currency creation, which destroys confidence in the dollar itself. There is no third option. This is not theoretical economic modeling. This is observable reality in current Treasury market dynamics. The rise of central bank digital currencies is being presented as technological innovation. It is not innovation. It is preparation for a post-dollar monetary framework. China's digital yuan is already operational in cross-border settlements with multiple trading partners. Russia's digital ruble is in advanced testing phases. Even the European Central Bank is developing a digital euro with explicit language about independence from dollar clearing systems. These are not competitive products in a free market. These are alternative infrastructure being built by nations that no longer trust the existing system. And increasingly, that alternative infrastructure is being designed with gold settlement features embedded in the architecture. Not a return to classical gold standards with fixed exchange rates, but hybrid systems where digital currencies can be converted to physical gold at central bank windows under specific conditions. This provides the flexibility of fiat currency, with an escape valve to hard assets when confidence deteriorates. The dollar system offers no such escape valve. Once you hold dollars, your only options are other fiat currencies or dollar-denominated assets, all of which are subject to the same underlying risk: the devaluation of the currency itself. Corporate leaders managing international supply chains are beginning to recognize the exposure this creates. A multinational corporation with revenues in multiple currencies, but costs and debt denominated in dollars, faces existential risk if the dollar weakens significantly. Not because their business model failed, but because the monetary denominator shifted beneath them. This is not a problem that can be hedged through conventional derivatives, because the derivatives themselves are priced in the same system that is failing. The only genuine protection is diversification into assets that exist outside the dollar framework entirely. Hard commodities, physical precious metals, real estate in stable jurisdictions, equity in productive businesses with tangible asset backing, not financial abstractions, Not paper claims, not digital entries in dollar-denominated accounts. Actual things with actual value, independent of any single currency system. The historical precedent for what happens when a reserve currency loses that status is well documented. The British pound served as the global reserve currency for over a century. Between 1945 and 1976, it transitioned from dominance to irrelevance. The process was not smooth. It involved currency crises, debt defaults, emergency IMF interventions, and the effective economic collapse of what had been the world's largest empire. Britain did not lose reserve currency status because of military defeat. They lost it because they could no longer generate enough real economic output to support the currency's international role. The mathematics simply stopped working. The United States is approaching the same mathematical impossibility. Federal debt exceeds $35 trillion. Unfunded liabilities for entitlement programs exceed $100 trillion. The only way to service this debt without default is through currency debasement, which destroys the very confidence that reserve currency status requires. This is not a political problem with a policy solution. This is a mathematical problem with a mathematical conclusion. The gold price, crossing $5,000, is not predicting this outcome. It is confirming that sophisticated investors have already priced it in. Russia's permanent exit from dollar settlement is not causing this outcome. It is acknowledging that the outcome is already inevitable. China's destruction of the paper gold leverage mechanism is not triggering this outcome. It is removing the last tool that was disguising it. The convergence of these three events in a single week is not coincidence. It is recognition. Recognition that the monetary system, which has governed global commerce for 8 decades, has entered a phase transition. And phase transitions do not happen gradually. They happen suddenly, after long periods of apparent stability. The business leaders who understand this are not panicking. They are repositioning, moving capital out of pure financial assets into productive real assets, restructuring supply chains to reduce currency mismatch exposure, building relationships with partners in multiple currency zones, treating the next decade not as an extension of the last, but as something fundamentally different. This is not prediction. This is pattern recognition. The patterns are clear. The data is public. The conclusion is mathematical. The only question remaining is whether decision makers will recognize what is happening before the recognition becomes irrelevant